JP.
Hey, Brandon.
Good morning.
Good to see you.
I brought you a gift.
Oh, awesome. What is it? Is a MiiR?
A MiiR.
M-I-I-R?
Yeah, check it out.
All right.
So I went to
nice.
Asheville. Yeah.
It's a mug.
It's a mug.
Nice.
I went to Asheville to the summit where it was like purposeful business.
Okay.
And this cat, Brian Pepe, I believe is how you say his last name, makes these mugs. And I love how your hand went like right to that handle.
Yeah.
That handle is just
Nice.
Beautiful designed. It's like
it fits my fingers perfectly.
That's exactly it.
There you go.
Yeah. His story's really cool. We'll have to get him in the newsletter.
Yeah, that'd be awesome.
It was better than the T-shirt that said, my boss went to Asheville and all I got was this lousy T-shirt.
It is better than that, I agree.
But I brought this today, and as I was bringing this, I was thinking, what a better way, good design,
Yeah, definitely.
than to talk about asset allocation.
Okay.
Yeah. Because asset allocation is the design of like everything we do.
Yeah, absolutely. It's the root of all planning that we do with wealth strategy.
And if you haven't figured out today we're going to be talking about asset allocation, but in different ways, because we at Conscious Wealth look at asset allocation in a number of ways.
Sure.
And as the wealth strategist on the team, as I build out these strategies, and you and Andrew really help co-create it and design the strategies even further, asset allocation is the backbone.
Yeah, absolutely.
Traditional asset allocation.
Yeah, stocks, bonds, cash, private investments, cryptocurrency, gold, commodities.
Which they call alternatives. Yeah.
Right.
Stocks, bonds, cash, alternatives.
Yes.
4 buckets.
Yep.
And alternatives is anything that's not one of the first 3.
Exactly.
Yep. Second one that like a lot of people like to use, and we use sometimes depending on the client and how they like to think about things, now, soon, and later.
Right. What are the assets supporting you now, immediately? Do you have enough cash on hand? Do I have enough to pay for my kids' college? Things like that. We have soon. Maybe we have stock options and RSUs coming due soon. That adds to your pool of assets. Or I'm buying a house.
Yeah.
And then later, will I have enough of whatever it is to be there for me when I retire?
Yeah. Another way of looking at now, soon, and later is cash I need now. Soon, something that gives me cash flow. So
Sure.
I'm getting income right away. Might be a dividend stock, might be a
rental property.
Yep. And then later is growth.
Yeah.
Right.
Making the pot bigger at the end.
Something we've been doing lately for some clients, all of these are imperfect, by the way.
Yeah.
Money that I need for myself and my lifestyle, money I want to give my kids or my heirs, money I want to give to society.
Yeah.
So my people, and then like other people. And that there again, all these have flaws, but it's one way of just building out 3 buckets.
Yeah, definitely. It's like we refer to that third bucket typically as impact, but if you think about it, it's kind of my immediate impact, the impact I have on my legacy, and then the impact I have on people that have nothing to do with me, right? And that can be done through people who are very charitable. Sometimes it's done by people who sell a business and they just have all this, they have more than they need, so they want to go out there and do something else with it. There's a lot of different instances where you can deal with that kind of planning.
Yeah. And then my favorite, which we've been doing a lot with entrepreneurs lately, is my stocks, my bonds, my cash, my alternatives, my impact investments, and my philanthropy.
Yeah.
So impact investments will be something like it's a business model. It has a revenue, but then within that revenue, that has a positive impact on society. This is not an impact investment, but it is a purposeful company.
Sure.
I talked to him on over the weekend, and he was telling me how he was in an ski accident, which I don't ski.
Yeah, I've been once. I fell a lot. I can see how you get in an accident.
Look, Kennedys die from skiing. I'm not safe.
Fair enough.
If they're not safe, I'm not safe. He broke a leg, got a steel bar, in his leg. Yeah. And started to rethink about a lot of his life. And one of the things he wanted to do was to reduce plastic. Back in the day, that was all plastic water bottles.
Sure.
Created a business model where not only is it a beautiful design, a B Corp, but then also reduces plastic.
Yeah. Yeah, this is a nice recyclable box. You can even see it on the bottom.
Yeah.
Nice metal reusable container.
So that is an example of something that would be a business model with a revenue. And also has a positive impact. And so that would be the impact bucket. And then there's philanthropy.
Yeah.
And philanthropy is something where there's no business model behind it, but you're
Sure.
giving it. So, for instance, I give to the mission in Atlanta,
Mhm.
and the mission actually helps young adults get off the streets.
Yeah.
Gives them a safe place to stay,
Mhm.
and if they're willing to, we'll help them try to get into transitional housing to full of housing. There's no real business model behind that.
Yeah,
There's
well,
not
there's
revenue.
no expectation of return. Right?
There's-
You're giving this money away to something good, and that's it.
No expectation of financial return.
Financial return. Sure.
Yes.
There's a societal good that comes from it,
Yeah.
hopefully.
Yeah. And it's like, so those are, and I like those buckets mean a lot for our clients who are entrepreneurs, maybe exiting a company and wondering, all right, how do I fill up all these buckets?
Yeah.
And all of the types of asset allocations are ways that we create strategy or design around our clients, or for our clients. And depending on what the client situation is, it might be one or the other.
Yeah, absolutely. And every time someone comes to us, the first thing we want to do is review their balance sheet. And a lot of people think of the balance sheet as like, oh, I have a house and I have a 401k. And that's true. You do have those things. But, sometimes you own a business. Well, how much is the business worth? Are you going to sell it? If you sell it, what does your life look like after the business, right? And then we think of, okay, so now we have our now. You're a business owner with a house and a 401k. We have our soon. What does the next, 1 to 5 years look like? Are people going to college? What does cash flow look like, et cetera? And then later, well, what do you do after you sell the business? What does that after chapter look like for you?
Yeah.
Every piece, like you said, needs a different asset allocation.
Well, the now, soon, later is also just a great way of creating to-do lists when we have
totally
when we have
keeps you on track.
But what everybody's talking about with asset allocation today, and might as well address the elephant in the room, which is the markets and the volatility, and people are saying, what do I do with my asset allocation?
Yeah.
And whatever his head Paulson, who bought gold 15 years ago, was like, I nailed it.
Nailed it, yeah.
15 years later, you're doubling down on gold, caught up. So I was driving home and mistakenly played the radio, which is even NPR, right? Because I don't get CNBC in my car. And somebody was just so smart, they just bought all gold. And so that was part of their asset allocation. But I talked about big picture, but let's talk about just the stocks, bonds, cash, and alternatives, and why that asset allocation is the most important factor in your success as an investor.
Yeah, absolutely. So the four main assets, really, stocks, bonds, cash, and alts, right? They each play totally different roles in a portfolio. By managing all those different roles, you can create something durable that is oriented to the future. So stocks typically are risky and they grow, right? So there's no separation between risk and reward. The more reward you expect, the higher risk you have to take to get there.
I like how you said that. The more reward you expect.
Yeah.
Not that you get.
Not that you get. You don't always get it.
Yeah,
right?
yeah.
And sometimes, it's amazing. Sometimes you have someone who works at a Coca-Cola, right? Kind of the staple company. And Coca-Cola for 10 years, their price was exactly the same as it was 10 years before that.
UPS before that.
Yeah. And now Coke is at all-time highs because of just everything going on in the market. People are going to stability. We'll talk about that in a second. But you couldn't have predicted Coke being at all-time highs in a market where the S&P 500 was down 15% the same year. Those things, if you had to pick something out of a hat, you'd be like, well, that's not going to happen. You throw it out, right? So what you have to do is think of, okay, I have a basket of growth assets. They're very risky. I expect that they'll give me some kind of long-term return, right? Since 73, it was 11%. The last couple of years, it's been more. Every rolling 10 years, it goes up and down with the business cycle. So then it's okay, well, that's great. 11% annualized return is amazing. However, the max drawdown, the most amount of money you've lost in 1 year, is 58%, right?
What year was that?
2008.
58?
58 was the max drawdown of the S&P 500. From that entire peak to trough area, it's about 18 months.
Okay, all right.
Months.
Yeah, I was looking at a calendar year. Yeah.
So 18 months on the peak to trough, 58%.
Got it.
If you lose half of your money, you have to double it to get it back, right?
Yes.
And so we saw from 2000 to 2013, we saw two major corrections in the market. We saw the dot-com bubble in 1999, 2000, and then we saw the great financial crisis, 2008. It took you from January 1 of 2000 to February of 2013 to make your money back if you only went long on stocks and you never added to the portfolio.
Particularly And this is the key point, if
Mhm.
you just went in the index.
Just when in the
Because
index.
now everybody's banging on the table like,
Sure.
I'm a boglehead, or I don't know.
Yeah.
Like, just buy the index
Sure.
and I'll be fine, because our short-term memory, which is a lot of investors have only been investing since 2008 or 2009, or don't look behind that and say, well, that always works.
Yeah.
So why wouldn't it always work? Right. Where you had a very long period of time in our recent history that has shown just buying all stocks, all of them, is not a successful way of getting a return.
Yeah, it's interesting.
I cannot underscore that point, that stock selection does matter, will matter again.
Yeah.
It's not like, oh, well, that was a thing of ancient history. It will matter again.
And even in recent times, like the Mag 7 was the Magnificent 7, because we all have to put some silly name to brand it on Bloomberg or CNBC or whatever. The Magnificent 7 was the 7 largest stocks in the United States. They basically sucked up almost the entire asset allocation of the S&P 500.
Yeah.
They were very concentrated.
Yeah.
The Mag 7 has had 2 drawdowns of over 20% in the last 2 years. 2022, 3 years. 2022, they were down 40% collectively.
Yeah.
And then even though they rallied this year, they're down another 20%.
Yep.
So it is one of those things where, when we think about the now, soon, and later, if you're going into retirement now, it does not make sense, I don't think, to put all your money in a risk on asset, because you need the money soon, right? You need that to live off of. Money is there to be spent on the things you need to provide a lifestyle.
Yep.
That's fundamentally the goal of financial planning.
Yes.
Yes.
That's all of this. Stocks, bonds, cash, alts, to reach a goal of a lifestyle.
Yes.
Or whatever your goal is.
Right.
Some of our goals is, I want to have this lifestyle, but I also want to make sure my kids have some form of education or house or whatever they say.
Sure. And
then I want my money to help people in society, because I don't believe people in society are all that different than me. And I want to be able to help them. So whatever your goal is, the goal, if you don't want to go crazy, is not to make as much money as possible.
It's not.
It can't be.
It can't be. And by the way, if you pursue that goal, once again, risk and reward there is an unbroken chain. You will never have a high reward investment without the potential of risk. So if you swing for the fences, just know you can pop fly into the outfield and lose what you're investing in. So that's why we take a balance.
Even our buddy Clay, our teammate, is not getting on the track and saying, I'm going to run the fastest race I can. He's got a specific goal in mind. Like, I want to get to this thing, which is like 2 seconds lower than it is now.
Right, yeah.
And then he becomes a professional athlete.
Yeah. If I can spend a year shaving off 2 seconds on an already impressive time. Did you know Clay just broke? He is now in the top 1,000 people ever to run the mile.
Clay is 2 seconds away from getting fired.
Yes, that's what we tell him all the time. Yeah. He's 2 seconds away from getting fired, and then getting rehired as a sponsored athlete.
Yes,
and going to the Olympics.
Yes,
yeah, it's crazy.
So we digress.
Yes,
the point of asset allocation is to reach a goal. Once we determine the goal, and that's really where I come in on the front end with a lot of the planning with clients, figuring out what is that goal, how do we design this asset allocation. And then we start filling these buckets, or we start filling them.
Yeah, then we implement, right? And implementation takes time. You have your entire career, your entire business career, your entire life to make these goals happen. And so once we get a good strategy on the front end, then that's where the work comes in, right? You have to routinely check in. You have to see what life events come up. You have to see if your kid got a D1 scholarship, or if they're going to private school or something like that. People get sick. There's all kinds of things that can change the plan. That's why we constantly come back to what makes sense for you now, sooner or later. Yeah,
and particularly all the variables around business.
Yeah, definitely.
Selling my business, buying a new business, merging, all these things around business. Sold my business, what kind of investments am I going to make now in new business? All of those are really just adjustments that we make.
Sure.
I think, though, we're still teasing the audience. We haven't talked much about asset allocation, so I will just throw my hat in the ring and talk particularly about ours and for our clients. One of the things before all of the volatility occurred, about, I don't know, plus or minus 100 days ago.
Yeah.
So once all that volatility occurred, we were already in a more defensive position. One of the things we've done recently through the investment committee, so this isn't any one person on our team making decisions. We sit together as a team. We have a team of 5. We talk about our asset allocation. We talk about our clients' portfolios. We talk about what's going out in the world. We look at what our choices are. We made another adjustment to our portfolio. And so we decided that there was more risk than reward in our fixed income portfolio.
Mhm.
And we moved a portion of our fixed income portfolio to cash,
Yeah.
or money markets, because we knew we were going to get an equivalent yield with less risk.
Right. Right. And no, I mean, that's last part is important. When we manage portfolios, one is we have a team of people who all have different opinions and different backgrounds. We come together and we come to consensus. That's really important for anyone to do, right? It's important when you run a business. It's important when you run a portfolio. The second thing is when we try to get returns for our clients, we're not going out there and making crazy decisions. We just think, okay, I have 1,000 ways to invest this person's money. Which one gets me the return that I need or that they specifically need while taking as little risk as possible?
Yeah,
Right.
a reasonable return with as little risk as possible.
Yeah. And there's a lot of ways to do that. And that's what we try to focus on every time we go to investment.
That's what we focus on. Yeah. And I think another thing that's key, as we made these asset allocations, it wasn't some Tom, Dick, or Harry in New York City making these decisions. It was us.
Yeah.
Like, we're not outsourcing this to other people. It's not people who don't know our clients. They're not some like CFA in corporate headquarters who's saying, well, I've never really managed money, but I think this is what we should do. No, we're sitting there with years of experience and saying, this is what we're going to do. Be right or be wrong. May we be right or maybe be wrong, but we have a process and we're going to stick to it, and we have rules, and we made these decisions. And it wasn't done out of fear. It wasn't done out of political calculation.
No, there's no.
When I say political, I don't mean what's going on in DC. I mean political, like, well, we have these clients and we have hundreds of thousands of clients we got to manage for, or we have shareholders. It's none of that. It's like one thing. We have this mandate to serve our clients, reasonable risk, a reasonable return with as little risk as possible. Yeah. And it was very straightforward.
Yeah, definitely. So another thing is that when we make these investment decisions, clients get notified, right? They get statements, they get trade confirmations, etc. And they don't really call us about it.
They really don't.
No, because they know that we're not just getting an article on CNBC and reacting to it. We're making these decisions out there in the market.
We have to make these videos to find out.
Yeah,
they don't even call us.
That's true.
Or they have to wait until we meet them next, or whatever. We have these scheduled.
It's actually
meetings.
Really nice to hear someone say, "Oh, I saw this on the video," and then have a question about it.
It is cool. It is very cool. All right, so asset allocation. Let's sum this up. One, it's all about design.
Yeah,
it's one of the parts I like most about this job is designing strategy for clients and allowing you and Andrew to really co-create it even further with our clients. There's a lot of different ways to look at asset allocation, but at the bottom line, it's a mix between risk and return.
Yep.
What else?
No, I think you nailed it. Ultimately, when we do these things, we have to meet the people where they are, figure out where they want to go, and then just build the asset allocation around that. That's the entire idea.
Yeah, and I guess the last thing I would say is that because asset allocation is such an important part of somebody's success, it's the most important component of their success. When we say success, meeting their goals, we take those decisions very seriously. And we have made 2 asset allocation adjustments over the last 18 months, which were pretty big for us. But they're not big like we went all to gold or we went all to cash or something like that. It's like, how do we move these? Because there are a lot of articles out there saying you need to do this and you need to do this. And you need to make these drastic moves. And more often than not, almost always it comes back, it puts you in a binary situation. You're either going to succeed or fail, and we can never be in that situation.
No, I totally agree with that.
Yeah. Let's go get a coffee.
Yeah, thanks for the cup.
Yeah, we'll have to bring Brian on or get him in the newsletter because he's just a cool guy and it's a great company.
Yeah, absolutely. All right, thanks, Brian.
Cheers, man.